Welcome back to Financial Freedom with Jewel. Today we're going to talk about school and education. Of course, we all learn 1 + 1 = 2, 2 × 2 = 4, so on and so forth, order of operations, statistic, home economics, all those kind of things. But there's still a subject I think they should have talked about more in school. It has set us up on a far better course, and that is dealing with loans and lines of credit. But I need you to give me one moment. I'll be right back.
You know I'm a stranger, willing.
Okay, welcome back to Financial Freedom with Jewel. As I said before, in school, we're taught so much, but I think it is a disservice when you don't teach students about financial literacy. If I had learned some things that I'm learning now, I'd be so far ahead in the game. But we can change that by teaching the next generation. By that, I mean, don't have people focus on taking out loans. Let's look at lines of credit. People say, well, you still have to pay back a loan. You're still paying back. I get it. But guess what? The loan and the lines of credit work far differently. For instance, let's say when you took out a loan, of course, it's going to be a fixed amount. We get that. Lines of credit is going to be a fixed determined amount. I understand they're on the same page there. But the big difference is that with a loan, it's one way in. You're going to feed that loan. You're going to feed that loan. Let's say you went to the banker and you say, hey, I like this $40,000 car. I'd like to go ahead and get it. He's going to say, hey, great doing business with you. Here's your interest rate. I'm going to give you 6 years to pay this loan back to me. He's not going to tell you that in the very first, 2.5 years, you're going to really be paying his car off first. You're going to be buying his car first. By that, I mean you're going to be having what they call front-loaded interest. They're putting all the interest at the top, making you make your payments as you're making those little small bitty payments that he's tricked you into getting into, or I shouldn't say trick. He said, oh, look at this little small payment. You can pay this over 6 years. You can afford it. I've seen your income. You're going to pay him all of that. But in the beginning, because he's put all the interest in the front, he's going to get his portion out first. And let's say on a 6-year note, by about year, 2.5, 3, you'll be able to start hitting the principal, your portion of it. Okay, now with the loan, that's what they do. With the line of credit, it's better because it's open-ended. You might say, what is open-ended? Yes, you're going to still make your payments, but because you can make your payment and you can also pull from it, it causes it to be open-ended. So I'm paying into it, but I can also pull from it. You say, what does that mean? I'll give you an example. Let's say, same $40,000 car, but in this case, you have a $50,000 line of credit. With that, if emergencies came up, you have $10,000 extra that you can pull from and you can use it. Now with the loan, you can never ever pull from a loan. You're going to feed that loan. It's like a leech. It wants more, it wants more. With the line of credit, something were to come up, you can access the extra $10,000. And the benefit of a line of credit is that the minute you make that payment, you guys, you're going to bring it down, which means you're going to have more money available to you. And your payment's going to go down. So you get this? With the loan, you're going to make the same payment for 6 years, whether you owe $40,000 or whether you owe $10,000. Your payment's going to stay the same. With the line of credit, as you bring down your payment obligation, your payments are going to come down. Isn't that the beauty of it? Oh, wonderful. Also, I want you to look at something and think about it. Think about a mortgage. When you get into lines of credit with a mortgage, the same thing happens. You're not stuck on a loan amortization schedule where you're making a small mortgage payments every single month. And guess what? They're sending a whole bunch of that to your interest, a little bit to your principal on a 30-year note. If you switch the narrative and take out a line of credit when you purchase your home, you're allowing yourself to, as your payment goes down on that mortgage, lines of credit mortgage, so does your payment every single month. With a loan, you cannot do that. Lastly, with a loan, let's say you decided that I've paid off this $40,000 car. I've done it for 6 years. I've maintained it. I've done well. And your credit has gone up too. And you say, you know, banker, I want to get another car. I want to go ahead and finance another car. He's going to take you through that whole process of qualifying for it. They're going to pull your credit report. They're going to look at your income. And guess what's going to happen? It's going to pull down your credit score. Now, if you had a line of credit because you paid that $40,000 back, guess what? You can pull from that again. No need to run a credit check. No need to say, let's see what your income looks like. No, lines of credit are good from 10, 20, sometimes even more years. So a line of credit is the far way better to go because as I told you, as your payments come down, as your balance comes down on your line of credit, so do your payments. And also, you guys, the beauty of it is this. With the loan, remember, they're front loading everything with interest. So they're packing all that into that payment, that little small payment that he's teased you with. But with the line of credit, guess what? You only pay on the amount that you borrowed. If you have a $50,000 line of credit and you were to borrow only $20,000 from it, guess what? You're only going to pay off of the 20,000, not the whole 50,000. So we got to start thinking differently. So as I said before, financial literacy is something I'm learning every day. It's ever evolving, but there are certain things you can do to put yourself on a really good course. Now, I wish I had learned this in high school, but I didn't, but it's okay. No time like the present. And as I always say, if you don't tell your money where to go, you're going to wonder where it went. This is a simple strategy to let you know when you consider what you're going to do with your finances, with your money, when you want to purchase things. Go to your local credit unions. They work for the people. They're not working for big box banks. They're not working for, shareholders. They're working for you. That's why they call them your neighborhood credit union. Check out your credit union. Take out a line of credit and make it work for you. And also, if you found worth in these videos, I need you to like and subscribe and share. Sharing is caring. Until the next video, I'll see you soon. Bye-bye.